Hi guys, I wanted to spend a few minutes talking with you about some of our basic concepts from chapter 1, starting with the accounting equation and analyzing transactions. I am assuming at this point that you have already familiarized yourself with those basic accounting principles and assumptions from those first few pages of the chapter. If not, make sure you have a good handle on what those mean. Let me know if you have any questions. Let's talk for a minute about, excuse me, my voice is not very good today. Let's talk for a minute about the accounting equation, which you see at the top of our page up here. Assets equal liabilities plus equity. This is the most basic part of accounting. No matter how deep you go into accounting, this little three-part equation will always be true. Let's review for a second what each one of these words mean. Assets are anything the business has of value, the good things. I like to think of assets by asking myself a question. Can it be converted to cash? If so, it's an asset. Now, I always say don't overthink this. Don't go, well, the market's not too good right now. The economy's rough. What if nobody wants it? Just the basic question, can it be converted to cash? Land, yes. Building, yes. Equipment, yes. Supplies, yes. Inventory, yes. What about cash? Of course, cash is already cash, so it's already been converted, right? So if it has value, could I sell it? Then it's an asset. Liabilities. Liabilities represent the debt of our company. Liabilities represent the rights of our creditors. Creditors have a right to some of our assets, mainly because we owe them money, correct? And money is an asset. So they have a right to some of our assets. And then equity represents the rights of our owner. So equity represents the value of the business to the owner. One way you can think about it is if we converted all of our assets to cash, and then out of that pile of cash, we paid off all of our debt, all of our liabilities, then what would be left over would be equity. And that would be the money that the owner would get to put in their pocket. It's theirs to do with what they want. Okay? Let me know if you have any questions on the accounting equation. Remember, it has to always be true. So one thing that we're doing in this chapter is we are learning how to analyze transactions. A transaction is anything that affects the economic position of a company. So the things they do on a daily basis. And I've got typed up for you here just a couple of examples. Now, we're going to record these transactions underneath this accounting equation. And we're going to do this using our specific accounts. These are account types or categories, and then we're going to have specific accounts under each category of accounts. I named some assets for you: cash, building, land, equipment. Our prime liabilities account that we're going to use for now is called accounts payable, accounts that we have to pay. And then our equity account, well, we have 4 different things that affect equity. Equity is affected by investments, withdrawals, revenues, and expenses. Okay? Investments. Investments is when the owner invests money into the company. Usually do that at the beginning when they start up the company. One of the first things they do is normally go open up a checking account. Withdrawals is when the owner takes money out of the business, typically for personal use. Revenue, remember, is the money that we earn doing whatever it is we're in business to do. And expenses Expenses is the cost of earning revenue, paying our rent, paying our employees, paying our electricity bill. These four things affect our equity. Well, two of these things increase equity and two of these things decrease equity. And I bet you already have a pretty good idea. Think of it like it was your business. If you had a business and you put money into the business, you made an investment, then wouldn't you expect the value of your business to go up? So investments increase equity. What about if you took money out of the business? You make a withdrawal, then the value of the business goes down. Okay, revenues. Revenues are positive, right? We're earning by doing whatever it is we're in business to do. If we're a shoe store, selling shoes. If we're a landscape company, cutting grass. Well, that's going to increase the value of the business, correct? And then the flip side of that coin would be the expenses that are associated with earning that revenue. And that's going to make equity decrease. So these are our four things. I think they have a nice little graphic in your book. I should have remembered what page, but I can't right now. I'm sorry. But I think there's a nice little graphic in your book that illustrates for you how these four things affect equity. Make sure you can remember those. Okay, so when we're analyzing our transactions, one very important thing you need to remember is every transaction has at least two parts. We've got to keep this equation in balance, which means I can't just write plus 500 on the asset side. I can't just say negative 3,000 on the equity side. If I did, I would no longer be in balance. So to keep the equation in balance, I have to have at least two parts. Think about that for a second, mathematically. I know I said it wasn't a math class, and I'm still holding to that. It's not a math class, I promise. But just think about that. We're going to have at least two parts to keep this equation in balance. I've got a few examples for you here, and I want to just show you what I'm talking about when I say make sure you're picking out both parts of the transaction. If we paid rent for the month, and it doesn't matter how much it is, $500, $1,000, $20,000, the amount at this point doesn't really matter. But if we paid rent for the month, if we paid something, that means we spent money. If we spent money, then our cash is going down. And cash is an asset. So that is the first part of our transaction. We're paying rent. Rent is an expense of doing business. And we said that expenses decrease equity. So equity would be decreased through our expenses. And in your illustration, in your chapter, they have it drawn out all nice and neat for you with all the little individual accounts listed out underneath each section. So you can look in your book for a more detailed illustration with all the accounts listed out. Purchased supplies for cash. Okay, let's pick out both parts. We purchased supplies for cash. If we purchased supplies, that means that we got more supplies. If we got more supplies, the balance of our supplies account is going up. So supplies, our asset, would increase. If we purchased them for cash, that means we spent money. If we spent money, then that means our cash account is going down. So one asset goes up, one asset decreases. We would still be in balance. What if we purchased equipment for credit? or on account? Well, anytime that we purchase something for credit or on account, that means I did not pay for it. If I don't pay for it, that means I am creating a liability. So pick out your two parts. Purchased equipment. If I purchased equipment, then I'm getting more equipment. So the balance of my equipment account is going up. And that would be an asset because equipment has value. If I purchased it on credit or on account, then that means that I didn't pay for it. I created debt, so my liabilities are increasing. So assets increase, liabilities increase. I would still be in balance. Anytime we earn revenue, revenues, we said, increase equity. When I earn revenue, I'm either going to get paid now or I'm going to get paid later. If I get paid now, I'm receiving cash. So equity increases, assets increase because cash increases. If I earn revenue and billed my customers or earned revenue on account, then that means my customers are going to pay me later. That is still an asset to me, and the account that we use to record that is called accounts receivable, accounts that I'm going to receive at a later date. So remember, anytime you earn revenue, either you got paid now or you're going to get paid later. Either way, it's an asset. It just depends on which particular asset that you're going to record it in. Okay? So those are just a few examples. They've got a lot of great examples in your chapter. Make sure you're utilizing your book. Make sure you're reading through those examples. You've got to remember to be picking out both parts of these transactions. We will continue to do this in Chapter 2, analyzing these transactions. So make sure you're becoming familiar with how to pick out both parts and knowing that cash is an asset, building is an asset, accounts payable is a liability account, capital withdrawals are our equity accounts, along with revenues and expenses in Chapter 1. Excuse me. Okay, so there's your little review on analyzing your transactions. The next part of the chapter talks about financial statements. I will make you a little video on financial statements, but I do have those Chapter 1 notes posted in your Chapter 1 module, and on those Chapter 1 notes, I have your little template, your little formula, whatever you'd like to call it, for your financial statements. Make sure you look over those notes and make sure you learn those financial statements. We will do them in the first chapter, the second chapter, and the fourth chapter, which means they will be on your first test and your second test. So go ahead and make sure you start learning those now. Let me know if you have any questions.